Alright, so there's a lot of things that have been said about index or passive investing over the years, but in my personal opinion, there's one thing that stands out amongst the rest as probably the biggest lie, or at least the most misleading statement about index investing. And that's that investing money in an index is only ever going to produce average returns because you're only ever going to match the performance of the market. Today, we'll be going over how this average return myth came to be accepted as more or less fact, as well as going over the data that proves just how incredibly misleading this idea actually is. Let's get started.
But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today.
So why do we believe that investing in index funds, such as the S&P 500, will produce average returns in comparison to other investments? Well, the first and probably biggest reason is that it's just been said so much and by so many people that we just tend to accept it as fact. That's pretty easy to do if you don't have the actual data in front of you to check out for yourself. It's part of the reason I'm doing this video, so we can discuss the data we have, and if you want to check it out for yourself, I'll leave a link to Morningstar's reports in the description below this video. The second reason is that there certainly are investments that do outperform benchmark index funds like those that follow the S&P 500 each and every year. It's not exactly common for a single investment to outperform the index over long periods of time, but it is possible. The third reason is that it's good for business. Let's face it, less of us would be using financial advisors to help us pick stocks if we knew that the vast majority of them fail to even match benchmark index funds. Which is unfortunate because a good financial advisor can still be well worth the money for a lot of people, even if they don't beat their index fund. They can be teachers, giving you ideas on how to manage your money beyond just which stock or mutual fund to pick. They can talk you off the ledge when things are going bad and you're considering selling your investments during a market crash because, let's face it, the behavior gap is very real. And if an advisor manages to steady you in the heat of a crash even once, they may very well have more than made up for their costs right there. So this video is not meant to be a shot at financial advisors or stock pickers or anything like that. It's just meant to clear up some misunderstandings surrounding index funds and other passive investments. But with that being said, what does the actual data say about the performance of investing in index funds compared to more actively managed funds or even investments outside of the stock market? Let's take a look and find out ourselves. So today's data is coming from Morningstar's semi-annual Active Passive Barometer report for August of 2019, because at least at the time I'm writing this script, that's the most recent version of the report that's been released. The report covers all the data through June of 2019. This report measures the performance of U.S. active managers of some 4,000 funds against their passive peers within their respective categories. The categories include large, mid, and small cap stocks, which are further broken down into value, growth, or blended funds, various foreign and international investments, real estate, both in the US and worldwide, and of course, bonds. If passively managed funds are really producing average returns, we would expect to see that actively managed funds manage to outperform them somewhere in the neighborhood of 50% of the time. But that often isn't what happens. Over the course of the last year, active managers of large cap stocks outperformed their passive peers a little over 30% of the time, with managers of growth stocks doing the best. Growth stocks actually outperformed 54% of the time, which is in the ballpark of what we should be expecting, but value stocks outperformed just 34% of the time, and blended funds only outperformed 32% of the time. If we look back a little further, we see that these success rates fall pretty much across the board. Over the last 3 years, growth stocks still did the best, but only outperformed the passive funds 38% of the time. Value and blended funds outperformed 33% and 29% of the time, respectively. And this story continues over a 5-year span, with growth stocks still outperforming their passive peers 30% of the time, but value and blended funds fell significantly, with their success rates dropping down to 15 and 13%, respectively. And over the last 10 years, the success rates of these actively managed funds cratered to their lowest levels. Growth and blended funds outperformed their passive peers a mere 8% of the time, with value funds doing even worse than that, with a success rate of just 7% since 2009. Now, these success rates do rise a bit in the last 15-year stretch and the 20-year stretch, with active managers outperforming their passive peers about 15% of the time in the case of this particular report, but even so, 15% of the time is not where we would expect to see them if passively managed index funds produced average returns. Now, I know what some of you are thinking. Well, that's just the large cap space. It's harder for active managers to outperform index funds there because almost all of those companies are pretty well known. It's tougher to find a diamond in the rough company that everyone else is overlooking in that space that will allow an active manager to outperform their index. And if we just look at the other areas of the market that are less thoroughly covered, we'd see a different story being told by the numbers. And there is some truth to that. So let's start by looking at mid-cap stocks. Actively managed portfolios in the mid-cap space did have higher success rates on average than their large-cap counterparts. Over the course of the last year, mid-cap growth stocks succeeded in outperforming their passive counterparts a whopping 79% of the time, which is way more than we would expect to see. Blended funds outperformed 46% of the time, which is about what we would expect to see. And value funds succeeded just 32% of the time, which is less than we would expect to see. But hey, all in all, fairly good. Over the course of 3 years, growth funds were still kicking butt with success rates of 59%. Value funds were hovering at around a 33% success rate, and blended funds saw a fairly significant drop from their 1-year score, outperforming their passive peers just 26% of the time. Over the course of 5 years, we start to see a similar story taking place as we saw in the large cap space. Growth stocks were admittedly still doing quite well, with success rates of 54% over the course of those 5 years. But the success rates of blended and value funds continued to underperform what our expectations would be. Blended funds succeeded in outperforming their passive peers just 14% of the time, and value funds just 24% of the time. And unfortunately for active investors in the mid-cap space, the buck stopped when we looked at the data for the last 10 years. Growth stocks finally fell out of favor compared to their passively managed counterparts, outperforming them just 29% of the time. Value funds fell to a success rate of 11%, and blended funds did even worse, scoring victories over passive funds in just 7% of the recorded cases. Similar to large cap funds, the 15 and 20-year time periods were an improvement on the 10-year span, but none of the fund categories managed to have a success rate of even 30% in either time frame, which, again, is way below what we would expect to see if index funds produced average returns. Small cap funds had a similar story to the mid-cap space. Growth funds had success rates of 75% over 1 year, 61% over 3 years, 52% over 5 years, 35% over 10 years, and 25% over 15 years. Value funds succeeded 45% of the time over 1 year, 44% of the time over 3 years, 39% of the time over 5 and 10-year periods, and 25% of the time over 15-year periods. And blended funds produced superior performance 45% of the time during the last year, 29% of the time during the last 3 years, 26% of the time during the last 5 years, 22% of the time over the last 10 years, and 19% of the time over the last 15 years. So now you may be asking yourself, okay, so at least based on the historical data that we currently have here, passive funds have more often than not beaten their actively managed counterparts, especially over longer periods of time. But does that hold true overseas? Or even in investments outside of the stock market, such as those in bonds or real estate? And the answer is, it depends. For instance, the actively managed foreign investments covered by Morningstar's report almost never outperformed their passive counterparts, and in fact, they rarely even came close to achieving success rates of at least 50%. Worldwide large cap stocks outperformed their passive benchmarks about 55% of the time over the course of the last year, but that success rate fell to 46% of the time over 3 years and continued dropping steadily from there. The emerging market space managed to beat their passive benchmarks about 55% of the time over 5-year periods and 49% of the time over 10-year periods, which is very impressive. However, they have been struggling more recently with success rates of just 34% and 43% over 1 and 3-year periods. So we'll have to see if that clears itself up as time goes along. Real estate did impressively well over the last year, with US-based real estate outperforming their benchmark 56% of the time, and global real estate posting success rates of 76% over the same time frame. However, the numbers did fall pretty quickly when we looked at longer time frames, with success rates for both US and global real estate hovering around 30 to 35% in most cases. Bonds actually probably had the strongest showing in this entire analysis, with the corporate and high-yield junk bonds posting success rates of close to or even over 50% in the majority of cases. But of course, that's measuring their success rates against various passive bond index funds and not real estate or stock funds. And I only mention that because this video is trying to figure out whether passive investments, and in particular the popular ones like the S&P 500 index funds, actually produce average returns. And of the categories measured in this report, bonds often had close to the lowest overall returns, while stocks had among the highest, as you would expect. So while holding an actively managed bond fund that gets you 6% a year in returns is great, especially when the passive bond fund only gained you 5% per year, it is worth considering that during that same time period, a large cap stock fund, such as an S&P 500 index fund, might have netted you 16% returns. And I'm not throwing those numbers out for no reason. That's actually the difference between the returns of the corporate bond fund and the large cap growth funds in this report. Corporate bonds, according to this report, had average returns of 6% per year over a 10-year period. Large cap, passively managed, growth stock funds averaged over 16% per year. Hypothetically, if you had invested $500 a month into the corporate bond funds over those 10 years, you'd have a net worth of about $81,600 today. Not bad. If you had invested in the stocks, your net worth would be almost $139,000. That's a difference of over $57,000 over the course of 10 years, or in other words, almost the entirety of your out-of-pocket investments during that time. Now obviously, that is a little unfair to the bonds, because the last 10 years that this report was covering was 2009 to 2019 when stocks were on a long bull run. But stocks have historically outperformed bonds over the long haul, so while this particular instance is a little bit ridiculous, the idea still is worth considering. Some asset classes just have historically done better than others. But that does bring up an important question. On average, how do the returns of actively managed funds compare with those of passively managed funds? Because it is possible that the best actively managed funds perform so incredibly well in comparison to the passive funds that our expected returns from choosing a variety of active funds would be higher than if we had chosen passive funds, even if we know that most actively managed funds fail to beat their passive counterparts. That may sound a little confusing, so here's how this would work. Say that we have 3 active funds and 3 passive funds to choose from. The active funds we'll call A, B, and C, just to keep things simple. The passive funds will be X, Y, and Z. We don't know what the future returns of each of these funds will be, so we decide to spread our investments over all 3 of the actively managed funds equally. We invest $100 a month in each of the 3 funds, and we do it for 10 years. Fund A ends up with an average return of 5% per year. Fund B produces returns of 8% per year. Fund C ends up being the big winner with average returns of 20% per year after all expenses and fees are accounted for. And for the sake of simplicity, we'll say that all 3 passively managed funds had returns of 10% per year. This means that Fund A and Fund B failed to beat their passively managed counterpart. But how does the value of our investments compare at the 10-year mark? In our hypothetical case, the actively managed portfolio would be worth about $72,000. While our passively managed portfolio would be worth about $62,000. Pretty sweet, huh? We won with actively managed funds despite fighting what seemed to be a losing battle. But is this how the data suggests it actually works in real life? Well, as it turns out, no. At least not over the long term. The report admittedly only gives the return figures of each category for the last 10-year time frame, but the difference between the average actively managed and passively managed returns were stark enough that I felt it was worth discussing. Because especially in the stock market, there can be quite a difference, and it's usually in favor of passively managed funds. On average, large cap stock funds showed the biggest difference, with passive funds outperforming the active funds by over 2% per year. Surprisingly, growth funds showed the biggest difference, even though that was where we saw the largest percentage of active funds succeed. Actively managed large cap growth funds averaged returns of about 14% per year over the 10-year time frame measured by the report, while the passively managed funds averaged a whopping 16.4% per year. Mid and small cap funds saw similar, albeit smaller differences, with passive funds winning by around 1% and 1.5% per year on average. The foreign, international, real estate, and bond categories were all pretty darn close to a wash in terms of returns achieved. But it is still worth noting that the average returns of the foreign, international, real estate, and bond investments were all dwarfed by the returns achieved by stocks. Average returns for the actively managed foreign and international investments were 7% per year. For real estate, it was about 12%, and bonds about 6%. Compare that to the near 15% average returns for passively managed large cap stock funds like the S&P 500 index over this time, and its returns look anything but ordinary.
But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.